Hi, today I want to share with you how you can make your trading entry precise and selective. Many of us as a trader, we don't have challenge with how to do our analysis, but most of our challenge is based on how to find entries, how we can make our entry precise and selective. Now, I want to promise you on something that if at the end of this video and after going through this lesson several times, you are still not profitable, it means trading is actually not for you. Because what I'll be sharing in this series and in the subsequent series all through this period from now till September, based on this strategy, is something that should have and will change your trading in a no small way. Please follow everything that we share carefully, make a note on it, and follow every principle step by step. It therefore means that you will no longer be trading randomly. You are making everything precise and selective. Alright? So you don't need to jump from one video to other. Just stick on this particular video from today and every subsequent video that will be coming after this particular video. So what are we looking at? How to make your entry precise and selective. I've received a couple of questions or some people trying to see, okay, how do we be sure to ask some question? In the description of this video, there is a link I'll be dropping. You can follow that link to reach me on Telegram to ask your question or whatever you want to discuss via that particular link. So let's dive straight into what this strategy is all about. Now we'll be dealing with our price action, and I'll be adding a few indicators just as you have seen on my chart. You can see that these indicators are actually very tiny. I did not make the line bold, and the reason being that the focus is not on the indicator. The focus is on price action. So the indicator is just an add-on. It's a primary tool of your analysis. So you don't need to focus much on the indicator. So having said that, let me run you through briefly the setup of the indicator. Now first we have our Bollinger Band. The period is 130, deviation is 2.0, shift is 0, you apply to close 1 pixel and the color is green. Then we have our moving average. The period is 25, shift is 0, exponential, you apply to close. And after that we have our moving average, the second one, with the period is 10, exponential is, the shift is 0, method is exponential, you apply to close 1 pixel, the color is black. So those are just the moving averages we'll be using for this particular strategy. Now I've received a series of questions. Some people usually ask me, what is so special about your Bollinger Band? Now the advantage of this Bollinger Band and what you'll be using this Bollinger Band to do is that the Bollinger Band gives a directional bias of how price move. So I know that, for instance, from this zone, anytime price leave the lower Bollinger Band, price is going to the middle Bollinger Band. And anytime price break the middle Bollinger Band, it is going straight up to the upper Bollinger Band. And whenever price leave the upper Bollinger Band, it is coming to the middle Bollinger Band. And when you come to the middle Bollinger Band, either it will go back to the upper Bollinger Band if it did not break the middle. And once it breaks the middle Bollinger Band, I know that the next target is the lower Bollinger Band. So this can help me to some extent predict the directional bias of the market. And you can see that this price has been hanging on this. Provided price has not left this band, I know that price will continue in this upside. So that is what I want you to do. And if you want to determine the trend of the market, to determine the trend using the Bollinger Band, all you need to do is for you to pay attention to the higher time frame, which is the 4-hour and the daily time frame. So it means that whenever price is above the middle Bollinger Band, uptrend, when it's below a downtrend, then our moving average, we use our moving average for our entries. That is what we use the moving average for, strictly for entries, nothing more and nothing less. So now I will be finding this entry on our H1 time frame. Now here are the rules. Condition number 1, mark up your support and resistance. Mark out your support and resistance. As you can see now, you can see my support and resistance level being marked out. All the shaded portion are my support and resistance level, my supply and demand zone. Mark your point of failure and point of reaction. What I mean by point of failure and point of reaction is, for instance, at this level. Okay, for instance, at this point, you can see that price through a wick. So this wick is point of failure. While this place that has a body where price turn from is point of reaction. So you have to mark out both point of failure and point of reaction. This markup should be done on either H4 or your daily time frame. That is basically what you do on your H4 and your daily. Mark out support and resistance, point of failure, point of reaction, and then you can stay on that time frame to determine your trend using the Bollinger Band, just as we have explained. Then after that, you move to your 1 hour time frame. Now here is my 1 hour time frame. So every of your entry is going to be on 1 hour time frame. Remember, we have a rules, so you are not just going to trade at random. Condition number 1, mark out your support and resistance, and then on higher time frame, then you move to your 1 hour time frame. And here we are on our 1 hour time frame. Now on our 1 hour time frame, just as you are seeing now, we will be trading for a reversal. When I say the reversal, what do I mean? For instance, price is buying and you are expecting the price should sell. That is a reversal from a buy to a sell. So you'll be trading just double top and double bottom. You see price is at a lower Bollinger Band. So this buy starts as an area of support or area of supply. So you will no longer be jumping into the trade. It must be a double top and double bottom. 2 leg, W for a buy and M pattern for a sell. And you will be making your entry based on 2 candlesticks. All of your trade henceforth is based on 2 candlesticks. First, a pin bar, and secondly, bullish engulfing candlestick pattern. Okay, and there is a rule to our pin bar. Let me try to illustrate the pin bar I'm talking about. If this blue candle is our pin bar, good, this is the body while this is the wick of the candle. You can see, so the condition is this wick must be 2 times bigger than the body. That is the type of pin bar we want you to trade. This wick should be 2 times bigger than the body. And if it is going to be a bearish one, it will look this way. It doesn't matter the color. What we want to see is let the wick be 2 times as big as the body of the candle. And your engulfing candlestick, of course, you know what the engulfing candle is all about. So this is now what you'll be looking forward to trade. So how do we make entry using this strategy? Having marked out your support and resistance, supply and demand, you come to your H1. Alright, This is for a reversal trade. This is not a continuation trade. So for the reversal, you are going to wait for your M and W pattern. You see price came down. That is your first leg, right? Price went back. Do you see that? It went back, and then look at price came down again for the second time. And in this zone, you can see that all of here, we couldn't get a reasonable candlestick pattern. Price keep doing that. And here we have a pin bar. There is this pin bar here. Yes, we have this small pin bar here. And then we have this other one that gives us this particular rejection. So upon this particular confirmation, and you can see that this closes above your moving average 10 and 25. So that is your confirm entry. This is your confirm entry. You will make your entry and then you pick your reference line. You draw your reference line, right? And then you can see the price has been moving in that direction. So this is for reversal. You do the opposite, you will have a sell. Now the other part of it is continuation trade. And what do we mean by continuation trade? Continuation trade is your second entry. So for instance, if you miss your first entry, you want to make a continuation in the direction of the trend, you will need a pin bar or an engulfing candlestick pattern. Okay, and right here we have one. So you want to see the pin bar closes above your moving average. Look at this one. Even if you close in between the EMA 10 and EMA 25, you will make your entry just as this. And if it closes above it, you will make your entry. So whatever the situation. So this is your buy entry continuation. You can see it. You will buy. Your stop loss is 10 pips below your pin bar candlestick formation. This is for your continuation trade. Look at here. We have another pin bar that closes above your 10 exponential moving average. But note, if you have a resistance or a support, you are not supposed to make an entry. You wait for price to break out of it. And then here we have this. You can see how price move. Okay, and here price hit a resistance and price begins to move to the downside. And since we are in an uptrend, all you need to do, you take your trend line, you mark it out. So you will be waiting for price to break the trend line back and continue in that particular direction. Remember, you can make a sell entry following this rejection of candlestick pattern. You put your reference line, but you know the overall direction of the market. So here we don't have any entry yet. We don't have any buy entry. Okay, here we have an entry. Look at this pin bar that closes above. So this would have been your entry. Here we have another entry. Okay, since you have entered here, your stop loss is 10 pips below, you would have been in this trade. Then the next you need to look, draw your reference line and wait. You can see that perfect. Price break, you exit your trade. And then you know that you are in an uptrend and we don't have a signal here. So you keep on looking for your entry. And look at here, we have a signal for a buy. You can see this closes above our moving average. And here we have our entry. And you can see the movement of price. Okay, remember we talk of engulfing candle. Here again we have another entry and you would have been in this trade. So this is how you will be taking advantage of this. Now I have spent so much time to explain the basic, the formation of how this thing is meant to be. Now in the subsequent video, I will not be showing the setup for the strategy again. I'll be going straight to explain in details. So this is more or less like an introduction. Do the setup while you expect the next video where I will run you through more detailed analysis on how you can take this trade. You see another entry. Okay, because the trade you are supposed to take is based on a 2 o'clock and a 4 o'clock trade. Here again we have another entry, 2 o'clock and a 4 o'clock trade. So in the subsequent video I'll be exposing you to more detail on how you will take that entry. And please, there will be a link in the description of this video where you can contact via a Telegram group. So see you in the subsequent video.